Bitcoin's 4-year market rhythm has returned to prominence after Mags, a well-known analyst in the space, argued that the cycle remains intact. According to this model, the market is currently in the 2026 bear market phase, with 2027 expected to be the next major accumulation window if the pattern holds. This rhythm has shown up consistently in Bitcoin's history, from the 2011 to 2014 cycle through the 2019 to 2022 cycle. Under that framework, 2023 was the buy year, 2024 was the hold year, 2025 was the sell year, and now 2026 is shaping up as the bear market phase. This pattern suggests that 2027 could see a return of accumulation, but only if the market follows the same rhythm as before. The strength of this argument lies in its simplicity and its alignment with historical data. Bitcoin's 4-year cycle is not a law, but a recurring pattern that has persisted despite major structural changes in the market. The introduction of spot ETFs, institutional investment, and tighter exchange compliance has altered the environment, but the cycle has still shown up in price behavior. That gives credibility to the claim that Bitcoin is now in the bear market phase of this cycle. Right now, most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Bitcoin is trading near $75,700, well below the euphoric levels seen in recent months. This decline suggests the market is no longer in a late-cycle rally, but is instead entering a cooling phase. That cooling is consistent with what has historically followed Bitcoin's strongest upside years. The pattern is not perfect, but it is consistent enough to be worth watching. The 4-year cycle is built on Bitcoin's supply schedule. Every 4 years, the network halves the block reward for miners, reducing the rate at which new Bitcoin is created. This supply event naturally influences market behavior, as investors anticipate future scarcity. The cycle has survived multiple market changes, including regulatory shifts and new financial products, yet the rhythm remains. That suggests it is more than just a coincidence. Still, the cycle should not be treated as a calendar guarantee. It is a framework, and like all frameworks, it can break down under new conditions. The market is evolving rapidly, and factors like ETF approvals, institutional adoption, and macroeconomic trends can shift the timing of cycles. But the pattern has held long enough to be taken seriously. The 2027 accumulation call is not a prediction, but a hypothesis based on historical behavior. If the cycle holds, 2027 could be a time for investors to look for opportunities as the market shifts from bearish to bullish. But this call requires discipline. Accumulation windows are not automatic buy signals. They require careful analysis of market conditions and price behavior. The current bear market phase is a test for the cycle model. If Bitcoin continues to trade below recent highs and shows signs of cooling demand, the model gains more credibility. If the market breaks from the pattern and enters a new phase earlier than expected, the cycle framework may need to be revised. What? Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Investors should watch now is whether Bitcoin's price behavior continues to follow the bear market pattern of the cycle. That includes looking for signs of reduced trading volume, lower retail participation, and a shift in sentiment toward caution. If those signs persist into 2027, it could confirm the next accumulation phase is on the horizon. The next signal to watch will be Bitcoin's price movement and market sentiment in 2027. If the cycle holds, we may see renewed accumulation and a return of investor confidence. If it breaks, we may need to look for new patterns emerging from the evolving market structure.